I think their independence is going to remain. I don't see that as a high probability. I think what's even more important is the reason why I wear an End the Fed hat. It's not the same reason why most people would want to end the Fed. Most people want to end the Fed because they believe that the Fed controls the economy, and they believe that the Fed controls the dollar, and they believe that the Fed controls interest rates. I don't believe that if the Fed does quantitative easing, as an example, and takes their balance sheet from whatever, call it 6 trillion up to 6.5 trillion, I don't think that has any impact at all. If you really understand how the monetary system works, you realize that banks really don't need bank reserves. And the evidence that I would point to is in 2007, prior to QE, the Federal Reserve had about 40 billion in bank reserves that the banks were actually using for interbank settlement, right? Where M2 is 7.5 trillion. And by the way, you go back to 1980 and the system had 40 billion in bank reserves. Exact same amount, but M2 was 1.5 trillion. That's exclusively US M2. That does not include global M2. But the bottom line there is the banks can settle on their own balance sheet. They don't need the Fed's balance sheet to do that. So the point is that the Fed isn't at the center of the monetary solar system. The banks are. And it's because they're distorting markets, not through mechanics, but through psychology. The only thing the Fed does do, that they bail out the banks. And that absolutely, unequivocally, without a doubt, makes a big difference. That plays into the psychology. But it isn't necessarily because the banks don't have enough reserves. It's just the banks aren't willing to lend to other banks. So they have the ability to, they just don't have the willingness. But outside of times of crisis, like 2008 or when they set up the BTFP, that's a perfect example. Outside of times like that, the balance sheet, in my view, really doesn't matter. There are no atheists in the foxhole. So you sit there and claim that I want to take the pain, we got to take the medicine, and we've got to get rid of this financialized economy. And that's all fine and dandy. And everyone's, singing from the same hymn book until the unemployment rate goes up to 10%, until you have the crisis, until you have the economic pain. And then especially today, we just wave the white flag as fast as we possibly can. I mean, the COVID was a perfect example. And another way to look at it is look at how the bailouts have progressed. We start with just long-term capital management. Then you go to, TARP, I believe, was the bailout in the GFC. What was that, 800 billion? That's like a rounding error compared to what we did during COVID. And it's a lot faster too. The response time is a lot quicker, which tells me that the American people as a society can tolerate less pain, not more pain, regardless of what they tell you on Twitter or regardless of even how they vote. Trump likes to say that, he doesn't care about the stock market and all these things. Okay, but, he does care about a recession. He does care about a depression. How do I know that? Because he told us, right? Remember when the bond market froze up? What was that, April 9th, 10th, something like that? And all of a sudden, the very next day, he's like, oh yeah, sorry, we're going to do a 90-day pause. All the chest beating and everything that I did before, and I'll just forget that for a moment. And if you have any doubts, don't worry, art of the deal, 5D chess. But he comes out and does the 90-day pause, and he explicitly said, because I'm cool with a recession, but I'm not cool with a depression. And then let's also look at another thing they're trying to do, is they're trying to reduce the deficit. What's going to happen in a recession? The deficit's going to skyrocket in a recession, right? And that's not even they spend much more, which they will, but it's the tax receipts will absolutely plummet, right? Because tax receipts, as of the last 30 years, really tied at the hip with equities. And so if that goes down, so are your tax receipts. And look at what Trump did during the surveillance sickness. Let's remember that the stimmies, that was not because of Joe Biden. That stimmies, the PPP, the lockdown, all that stuff, that was under Trump. That was not under Kamala Harris or Joe Biden or whoever you want to blame it on, right? So if you're pissed off that we had the huge consumer price inflation of 2021, 2022, you got to lay some of the blame on Trump. And if his actions of the past can help us predict what he has the tendency to do in the future, if we go into, unemployment, let's just assume for a moment that spikes up to 7-8%. The stock market goes down by another 20%. We start to see housing going down, and you do get a couple quarters where it's obvious that we have negative real GDP. I see Trump doing something. He might not lift the tariffs. He might still talk a tough game there and try to negotiate these deals and whatnot. But I think that the fiscal side of the equation will definitely change quite substantially. And if that happens, then the Fed is going to have a lot of cover to go ahead and cut rates, because in that environment, we're not going to see the CPI, skyrocketing. Even if we do have tariffs, likely the CPI is going to come down. A lot of people talk about stagflation, and I like to point out that during the 1970s, when we had those recessions, they were disinflationary. People, I don't know that they've looked at a chart, because they just assume that the inflation rate just went up constantly throughout the entire 1970s, and it didn't. So as an example, 74, 75, when we had that recession, when the CPI topped out at around 10, 11, something like that. And then once you had the unemployment rate spike, which is what we see in pretty much every single recession, then you saw disinflation, where the CPI went from, let's just say it was 11, it went down to maybe 4, 5, something like that. But it did that over a 2-year span. So within the 1970s, you had disinflation for 2 years. Now, it is true that the CPI was still high. 4 is still way above where it should be. But it just goes to show you that our starting point right now is 2.4. The probability that it's going to be higher than 3 once you see that unemployment spike is incredibly low, even with the tariffs. Because back in the 1970s, it was oil. So if oil is an input to every single cost, how do we not have accelerating inflation? How do we have decelerating inflation? And the answer is because if incomes aren't going up at the same level, whether it's oil or tariffs or whatever it is, the consumer is having to rob Peter to pay Paul. So you have some prices going up, but because that aggregate demand is being taken away from another part of the economy, you have those prices going down to the point where the unemployment rate goes up, and then these prices have to come down as well, which is when you get that overall or that rapid decline in the CPI. So, another thing too that's interesting is the money supply. So people will say, well, this time, if we go into a recession, we're going to see the inflation rate skyrocket because we had all the quote unquote money printing from 2020 to 2022 when the M2 money supply went up by 20 or 25%. But what's really interesting is if you go back to 70 to 74, the money supply growth was actually higher than it was from 2020 to 2024. And we still had disinflation with the recession. So I don't really like treasuries, but in this type of environment, I'd rather own treasuries than equities, for sure. The conservative investor in me, which is what I am at the end of the day, would say gold. But if I'm going to harness my inner speculator, I would probably go with Bitcoin. And the reason I'm going to stick with gold is because I know why the price is where it is today. And therefore, I'm comfortable having a base case or a prediction as to where it will be in the future. Where with Bitcoin today, I don't know, to be honest with you. I don't know why it's at 97,000 as opposed to 87 or 107. And therefore, I'm just going to try to play it right down the middle and be a little bit more prudent about it. I do really like commodities. I think we're in a commodity super cycle, but that doesn't really mean that commodities go up over the next year. If you think about volatility, most people think they have a diversified portfolio, but it's not, because they'll say, oh, well, I'm completely diversified because I own commodities, I own equities, and I own real estate. Okay, that's all assuming that volatility is going to decrease. Because if we go into an environment where volatility is ever increasing, then it's likely that all 3 of those asset classes go down. So you're not diversified, right? A true diversification would be if you have a portfolio that is hedged for volatility and you had components of your portfolio that were long volatility. And I think that's most people's blind spot. Most people perceive money to be commercial bank deposit liabilities. So if they look at their checking account balance and they have $1,000 in there, they think that they have money in the bank. And it's an illusion. It's just simply an IOU. It's a receipt. What the public perceives money to be is what is most important when you're trying to figure out the monetary system, when you're trying to figure out interest rates, the gold, silver, Bitcoin, farmland, whatever it is, right? Because it's not about what you think, it's about what the market thinks when you're setting up a portfolio. And the market believes money is fiat currency. And fiat currency in today's modern monetary system is not green pieces of paper. It's just simply commercial bank deposit liabilities. So if you understand that the financial players, the whole entire world, other than, some Austrians and sound money guys, see money as something that commercial banks can literally create an infinite amount of, with or without the Fed, by the way, then I think it helps you better understand the system, which in turn will help you better set up your portfolio. Over the next 6 months or a year, I think the gold-silver ratio is where it is for a reason. I think the market's pretty much telling you everything you need to know, because it is true that you've got that industrial component, like you said, and I think that silver is just telling us that there's a high probability of a recession. And so I would much prefer to buy silver, especially if gold dips. If we do have a liquidity event and gold goes down by, let's just say 15, 20% or something like that, usually what triggers the reversal of that move is the Fed coming in and doing the psyops like QE. And then all of a sudden the market's like, the Fed's got our back. And once you get past the liquidity event, then silver probably takes it on the chin even more than gold. And that's when I would want to be overweight silver as far as a speculation.